Good afternoon, financial professionals. Doug Twitty with E4 Insurance Services here, welcoming you to The Brew, which stands for Building Relationships Every Week. Thank you for tuning in today. For those of you joining The Brew for the first time, welcome, and thank you for your time today. We like to start the Brewcast by celebrating today's National Day. Today is National Everything You Do Is Right Day. So test out a theory and declare your rightness no matter what. Talk politics with the in-laws and tell your wife that that item she asked you to look for wasn't there, and you'll actually be right this time. Well, lastly, I'd say tell a good joke. Linus, if you want to run with me, knock, knock.
Who's there?
Owls go.
Owls go who?
That's right. They do go who. Today on the Right Brew, as part of our practice management series, we have Linas Sudzius, president with Advanced Underwriting. Linas holds his JD, CLU, and CHFC. He's a published author and has partnered with E4 on past cases as an advanced markets attorney. Linas is extremely knowledgeable in many areas and an excellent resource for our advisors. Feel free to use the chat box to share your thoughts or ask questions while Linas is live. Also, all attendees are in a drawing for a prize that we'll announce at the end. Thank you for tuning in. Linas, the mic is yours.
Oh, thanks, Doug. And by the way, everybody, just in case you want to get it right, it's Linas, not Linus, but it only happens to me every day, Doug, so no worries at all there. So we're going to talk about IRA deadlines today. And I thought it would be particularly timely to talk about these things, as for many of the deadlines, they're coming up. And so, they're just things to kind of be alert to as you're, thinking about reasons to touch base with your good existing clients, or you're thinking about reasons to go touch on people who might become clients. I think IRA deadlines this time of year is a particularly good topic for you to kind of talk to them about. So let's go ahead and get started on that. We're going to talk about regular contribution deadlines for both traditional and Roth IRAs. We're going to talk about SEP IRA contribution deadlines, which are not the same as the regular contribution deadlines. We'll talk about simple contribution deadlines for those of your business owning clients who have simple IRA plans implemented. We'll talk about rollover and conversion. Why are we going to talk about rollover and conversion? Well, here at Advanced Underwriting Consultants, we answer questions from producers all day long, every business day. And these are questions that end up getting asked over and over again. So we'll kind of review the answers with you. We'll talk about curing excess contributions into traditional and Roth IRAs. We'll talk about minimum distribution deadlines, which are coming up soon. For those who are taking their first minimum distributions. And then we'll briefly touch on QCDs, which from my perspective are underused and underpromoted by those of us who are in the financial services business. So let's go ahead and get started. Let's talk first of all about regular contributions into IRAs. To count for 2021, it's still possible for our clients to make contributions. They have to be deposited by the due date for the return for 2021, which this year is April 18th. Good funds must be deposited on or before April 18th of 2022. As one of the changes that has been made recently, there is no age limit for IRA contributions, as there has been in the past. However, earned income is still required for somebody to be able to make that 2021 contribution by the April 18th deadline. It is possible for folks to deduct their traditional IRA contributions. However, if they are active participants in pension plans at work, they may or may not be able to do so, depending on their income level. But in any event, in order for somebody to get that deduction for 2021, the deadline has to be honored. For somebody to be eligible to make a Roth IRA contribution, again, earned income is needed, and they can't be over the adjusted gross income threshold in order to be eligible to make a Roth IRA contribution. And here's a question that we get asked about just about every year. If somebody bounces a check by making a deposit just before the deadline, can they make the funds good after the deadline and still be able to qualify for last year's contribution? And the answer is no. And from my perspective, it's one more reason to encourage your clients to get their IRA contributions in early, just because if there's any question about whether funds are good or not, they'll be able to fix mistakes prior to the actual contribution deadline. And to count for 2022, again, contributions will end up having to be made prior to the due date for the individual return for 2022, which as of right now stands at April 15th, 2023. So those are the regular contribution deadlines for IRAs. Now, what about if we've got a business owner who has implemented a SEP IRA plan at their business? Well, the contribution deadlines are not the same. There's an extra time for those who have filed extensions for their business income tax returns. And that is that for corporations or partnerships, or LLCs taxed as corporations or partnerships, if those entities have filed an extension of their tax returns, the normal tax return deadline is March 15th, which means that the extended deadline is September 15th. The SEP contribution deadline for those types of entities is also September 15th if they filed an extension for their return. So there's a longer deadline, longer potential deadline for contributing to a SEP to count for last year for those business owners. If the business owner is a sole proprietor, the business filing deadline is April 18th, and that makes the extended deadline October 15th. And so SEP contributions for a sole proprietor can be made as late as October 15th of 2022, and they would count for last year, assuming that the sole proprietor has filed for an extension. So those are the deadlines to kind of keep in mind for our business owning clients. A lot of them implement SEPs because they're easy to implement. You use a standard IRS form 5305-SEP to implement a SEP in most businesses. Contribution limits, 25% of salary, 20% of net self-employment earnings, up to a maximum for 2021 of $61,000. Contributions are considered to be all employer contributions, and everybody's got to be included. Anybody who's made any substantial money, who's worked in the business for a while, has to be included in a SEP, which is why not every closely held business owner does them, but a lot of them do, because they're really easy to implement, really easy to fund. And to count for 2022, like to count for 2021, contributions are due by the extended due date if an extension is filed of the return for the business for 2022. So those are the deadlines we're paying attention to there. With simple plans, it's a little bit different. Simple plans look a lot like 401k plans in that they are made up of both employer and employee contributions. Now, simples are pretty easy to implement too with simple documentation, but because they're a mix of employer and employer contributions and employee deferrals, there are different deadlines. The employee deferrals were due by the end of the year. The election to make them and put them aside was the end of last year. Employer contributions are due by the extended due date for the return. So they're the same as the SEP contributions. Employer contributions, whether they are matching or non-elective, have still some leeway to count for last year, but employee deferrals needed to be made by the end of last year. Deferral maximums $13,500 for 2021, a $3,000 catch-up. Really easy to implement simple plans with standard IRS forms for most businesses. Employers can decide to structure their contributions as either matching or as put in for everybody who's an employee. Those are non-elective contributions. But simple IRA contributions or and the choice of carriers that you have open to you are a little bit more restricted than they would be for SEP IRAs. The universe of carriers is a little more restricted, so you got to pay attention to that. And the deadlines for 2022 contributions are similar to those for 2021. Employee deferrals by the end of the year, employer contributions by the due date or extended due date for the return for the year. Usually this time of year, we get calls from people who are working with clients who say they want to do a conversion or a rollover that will count for last year. And they think they can do it by the due date for the return, April 15th of this year. And the answer to that is no, you can't. You got to do it by the end of the year. At least you got to start it by the end of the year for the year in which you intend the rollover or the conversion to count. The question comes up more commonly with regard to conversions and the client choosing which tax year the conversion is going to be counted in. And so if you wanted the conversion to count as being taxable in 2021, you needed to start it in 2021 for that to have been eligible. It's possible to do conversions, Roth conversions, either by direct transfer or 60-day, the 60-day process. You can also do rollovers that way. If a client chooses to do a rollover or a conversion by 60-day rollover, the indirect method, they're going to get Form 1099-R that says something different from what they intend. And so you've got to kind of coach your client through what the 1099-R is going to play and what remedial efforts they might need to make on their personal income tax return to reconcile the 1099 that they just got for 2021 with what they actually did, whether it be rollover, which is tax-free, or conversion, which is taxable. So that needs to be thought about, and perhaps you can touch base with your client. Conversion's taxable in the year that it starts. We get a lot of questions about that, somewhat commonly on direct transfers from an IRA to a Roth IRA, for example, but more often where somebody's trying to do a conversion through the 60-day method, where the original distribution was taken, say, in December of 2021 and not redeposited it into a Roth IRA until, say, January of 2022. The tax result is attached to the year in which that started. And the 1099 is going to reflect that a distribution was taken in 2021 under those circumstances. We've seen a lot of press on the backdoor Roth idea. That's a conversion. It's not as simple as it seems. If you've got questions about that, reach out to your friends at E4 or let us know. There's a lot of misinformation about that. In the short time we've got together here, I'm not going to go into a lot of detail, but just know that backdoor Roths are not quite as easy as they feel. And then 60-day rollovers require some extra work on the client's behalf, particularly reconciling on the income tax return, what 1099-R has reported. And remember that 60-day rollovers from IRA to IRA are limited to 1 per 12-month period. And the same kind of time limits apply for stuff that is intended to count in 2022. What if somebody's made an excess contribution to an IRA and really didn't intend to? The IRS has said if you take it out in general by the return deadline for the year, including extensions, and you take out the excess plus any earnings on it, the IRS will treat it like the excess extra was never made. And that's a good thing. For individuals, the filing deadline's October 15th, and so they've got some time to fix excesses. Why is it important to fix excesses? Well, if you leave excesses in IRAs or qualified plans, there's a penalty tax of 6%, and it applies every year that the excess remains in, say, the IRA. And so it's certainly something our clients would want to fix. excess contributions into a SEP are extended due date for the return for the year in question, which might be September 15th or October 15th, depending on the business type. Excess contributions to a simple plan, that also depends on the business type. And, you know, it's not just taxation that we worry about if we've made excess contributions to a SEP or a simple plan. They also risk plan disqualification. And so we want to avoid those circumstances. And so those things need to be fixed in a timely way. If there are questions about that, again, talk to your friends who have some expertise about this and can help coach through how to fix excess contributions. But in general, if they're addressed by the deadlines, those contributions will be treated as if they had never been made. Minimum distributions, they are generally due by the end of the year for which they are required. However, if somebody turned 72 last year, they have until April 1st of this year to take their first RMD from an IRA. If they're still working for an employer and they don't own the company, they can defer RMDs for as long as they stay working for the whole year from those employer-sponsored plans. But otherwise, first RMD due for the year they turned 72, that RMD can be taken if 72 was last year by April 1st of this year. Otherwise, all other RMDs are due by the end of the year. Still working doesn't work for RMDs from IRAs. You got to take your IRAs solely based on your age. For all non-inherited IRAs, RMDs can be taken from just one. RMDs are not eligible for rollover or conversion. We often get asked whether an RMD can be converted to Roth. It cannot. Annual RMDs appear to have been eliminated for most non-spouse beneficiaries of IRAs. There's some ambiguity over that because the IRS just proposed some regulations which seem to say in certain circumstances the answer is otherwise. We think the IRS is wrong, but we still think the answer is post-secure annual RMDs are not going to be required. And if somebody fails to take an RMD they're supposed to take, the tax code imposes a 50% penalty tax, 50% of the amount by which they didn't take enough, right? Which is a severe penalty. That's the bad news. The good news is that the IRS has a whole procedure for being able to sidestep that penalty. It's filing IRS Form 5329 with a letter of explanation / apology to the service. And we have similar deadlines for RMDs that are due for 2022. Let's talk just a second about QCDs. From my perspective, QCDs are underutilized. Those who are older than 70 and a half have the ability to send money directly from their IRAs to charity. The QCDs have to be done by the end of the year to count for a particular year. They are available to all those with IRAs who are older than 70 and a half. The age has not changed to 72. Available to those older than 70 and a half, up to 100 grand a year. The check has to be sent directly from the IRA custodian and made out to the charity, right? That's part of the deal. It's better than taking a distribution and writing a check because the QCD goes, first of all, towards satisfying the RMD, but better than that, it doesn't hit the taxpayer's income tax at all. So they don't have to worry about deductions or anything like that. It just doesn't hit their income tax at all. And if they have an RMD obligation, it goes toward counting toward their RMD. So from my perspective, anybody who is RMD age, who has IRA balances, who gives money to church, synagogue, or charity of choice, they ought to be making those gifts from their IRAs, all things being equal. What would I prefer that you take away from this? Well, first of all, IRA deadlines can be tricky and confusing. They can be tricky and confusing for us. They're certainly going to be tricky and confusing for our clients. There are different kinds of deadlines depending on whether we're talking about traditional Roth IRAs or employer-sponsored IRA plans. And it's an opportunity, right? An opportunity to reach out to our clients, talk to them about the deadlines, make sure that where the deadlines apply to them, they're meeting the deadlines, and that we have a chance to answer their questions about IRAs and Roth IRAs and simple and SEP plans as our clients move forward. From my perspective, it's a very timely and efficient way to touch base with our clients. And so at this point, what I'd like to do is I'd like to thank you for joining us and turn the program back over to Doug. Doug?
Thank you. Great share. Very informative. Great review for all of us. Feel free to unmute yourselves if you have any questions for Linas, which I'd like to point out today was National Everything You Do Is Right Day. So apparently my mispronouncing the first name was still right. We do have a couple of questions. This one came in pretty long. Let's see if I can read this. Can a client who has used the charitable qualified distribution make this modification, and will it still qualify as a tax write-off, or more appropriately, would simply have no tax consequences if the client gave the funds to a charitable endowment and that endowment then purchased life insurance on the giver to multiply the gift 2- or 3-fold? Would this or could this qualify for the charitable qualified distribution?
Yeah. So I'm gonna try to abridge the question, and I'll tailor my answer to it. So from my perspective, if you've got a choice between using QCD or taking a tax deduction, you're always going to use the QCD because it's simpler, and you don't have to worry about itemizing. You don't have to worry about AGI limits. If you're eligible for the QCD, you'll use it. You can't do both. You can just you can use one or the other. Can you use a charitable contribution? Can the charity use a charitable contribution to buy insurance on the life of the donor, thus potentially leveraging the gift so that the charity collects more ultimately? Sure, yeah, if you can convince the underwriter, right, which is always the biggest issue with charity-owned life insurance, that the amount of coverage is reasonable and the charity, is the right owner of that coverage, it's fine by me. I've got no objection to it.
Okay. And has there been any guidance from the IRS about timing of distributions around inherited accounts?
Yeah, there's bad guidance. At least, did I say that out loud? The IRS has proposed some regulations that I alluded to during the talk that I think are wrong. There's some based on the language of the Secure Act RMD rules, we're pretty sure that they're non-spouse beneficiaries. The only obligation they had when inheriting an account was to liquidate by the end of the 10th year after death. Okay. The IRS proposed regulations seem to imply otherwise, that if the original account owner was RMD age, RMDs are due along the way. Okay. I don't see it, but that's what we're a little bit unsure of right now. From my perspective, if I were working with clients and telling them what to do, I'd tell them to wait to take this year's RMDs for a while until that gets sorted out.
All right, thank you. If anybody else has questions, or if you think of a question, remember that you can email us at info@e4.insurance, and we will route it to the appropriate person. Just a reminder that today's brew is being recorded and will be posted to our website at e4.insurance. And if you would like to be notified every week when the new brew is posted, please subscribe to our YouTube page, where you can also view all past brews. Now for the giveaway, if you pick a number between 1 and 10.
Was that me?
Yes, sorry.
Yeah, all good. 3.
3. Let's see who the winner is. Did it pop up and I didn't see it? Steve Hauser is today's winner. Thank you. And be on the lookout for a Starbucks gift card. That'll be coming your way from all of us here at E4. Tune in next week for the brew as we welcome Dave Weber from Mutual of Omaha discussing IUL sales ideas. Thank you and have a right day.